Hello, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, August 9th, 2021 or 2025. Excuse me. Hey, I hope you're doing well. I hope you had a good trading week. I hope you're enjoying your weekend. And speaking of weekend, I appreciate you coming to my weekend review podcast. I hope it's going to be helpful and that you're going to find some value in it. What I'm going to do, the format for today is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back and we're going to take a look at all the trades that I entered, that I'm still in, that I exited. We're going to talk about why I entered the trade, what were the confluence of signals, what was the setup, what was my thinking, how I position size correctly, how I place my emergency stop, how I place my end of bar stop, how I go into a trailing stop mode, how I take partial profits if the position goes in my direction, and then how I am ultimately going to fully exit the trade, either to the upside or to the downside. So hopefully this will give you a good idea of how I trade, what I'm looking for, but really what it comes down to are confluences of signals with a good risk to reward ratio. That's really about, from a trader's perspective, it's about all we can ask for. And it's about the only thing that is in our control, because once we take the position, after that, we have no control over the position. So we better know what we're going to do at all moments. If the market does this, then I have to do that. If the market does that, then I have to do this. Because again, you have no control, but you need to know exactly what your trading plan is. And being patient, waiting for those confluence of signals with a good risk to reward ratio, that is the only control that you have before you get into the trade. And then after the trade, you need to follow your rules, right? It's okay to have losing trades. I have them all the time, but ideally I try to keep the losses small. Of course, on the winning side, it's nice to have big wins. And every once in a while, I have a really big winner, and that pays for all the little losing trades where I was not right on the trade. So that's really what it comes down to, and that's what I'm going to try to show you today. So after we go over all the positions and all the trades that I have, we'll do a little bit on trader psychology. Kind of dovetails into what I just was talking about, having if-then statements, having a plan. If it does this, I'm going to do that. If it does that, I'm going to do this. And this all comes down to trader psychology. It all comes down to having a plan and what it takes to follow that plan. That is the key. That's where you will find a successful trader is a person that has a decent setup, doesn't have to be the best setup or the best trading plan or process in the world. Even a decent one will do. Even a decent one, you'll make money, but the key is following it. So that's what trader psychology is about. So I always like teaching trader psychology because it is so important, and hopefully you learn something from it as well. And then last night I did go down through my entire watch list, both on the daily time frames and on the weekly time frames, and I have identified some potential symbols for next week that are getting close to those confluences of indicators and support levels that I've been talking about. They're not there yet. If they were there already, I may have already taken the trade, but they're getting close, right? So I go through the whole list and I look and I go, this one could make it next week. This one could. This one probably won't, so I won't highlight it. So I'll share those with you, right? It's always important to, in my opinion, to be able to look at charts when things are quiet, like on the weekend, and go, okay, here is Apple, for instance. If Apple got down there, you'd have an order block. You'd have a major moving average. You'd have a double bottom bullish MACD divergence. Maybe you have an RSI divergence. You have an ATR divergence. Maybe you have an under 30 over 30. And if these all happen at the same time, it doesn't guarantee you that it's going to be a winning trade, but it improves your chances a lot. And again, the best we can ask for is a confluence of signals with a good risk to reward ratio. The best world, that's all we can ask for. So when I go down through the list on Friday nights, that's what I'm looking for, and that's what I'm going to share with you as well. So I hope that's going to be helpful. I hope you're going to find some value in it. If you do, I really would appreciate it if you could hit the thumbs up button. It really does help out the channel, lets YouTube know that there's some valuable content here. And, if you, like I said, if you could if you could subscribe, that would be wonderful as well. And if you'd like to share this, please share it. Like to build the channel and get as many people learning about trading the correct way, right? It's because I really try to teach trading the correct way, and that's what I do every weekend with this. So I hope you find it helpful. So anyway, let's get this U.S. legal disclaimer out of the way, and we'll come back and we'll get started. So hang tight. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, thanks for holding on with me, and let's go through current positions. Not a stellar week for me. I mean, it was okay. With this market, things are either go straight up or straight down, as you've probably seen. And the ones that go straight up keep going up higher, and the ones that are low keep going lower. So it's just what we have at the moment. So there's been kind of slim pickings for at least the way that I trade. I'm not a momentum trader, and right now the market is really momentum based. So this is UNG. I did enter UNG here on the 31st of July. Why? Well, here this green box is called an order block. And if we go back into the past, what we will see is that there's an order block, if I can find it, all the way back here, 12/4/24. So a long time ago. But these order blocks, the way that I use them, seem to have memory. So what is an order block? Well, an order block is the following. It is the lowest bar close before market structure change. So what's market structure change? A market structure change, the first thing you need is you need a swing low. Here we have a swing low. That swing low is now followed by a swing high. After that swing high, you need a lower swing low. And then in the future, you need to take out that first swing high. So swing low, swing high, lower swing low. Here, we get above this swing high. This changes market structure from bearish to bullish. And was it correct? It sure was. But as soon as you change market structure, now what I look for is the lowest bar close, which is right here, before market structure change. Now, I don't buy these breakouts. But when this breakout occurs, now I've defined my order block, the high and the low. And the high and the low of this bar, you can see in the green, I've put out into the future. So the way that I trade is if and when, now that I know where the order block is, if and when the market comes back to that level, I consider that a smart money level. And if it gets back to that, it's probably ready for a bounce. And if it's not ready for a bounce and it fails, then it's a really good risk to reward ratio, right? I keep talking about levels and risk to reward ratio. So if we look here on 116.25, when we're way at the top, would you agree that if we know it's here and we look back here and say, oh, there was probably some smart money buying here? Yeah, in hindsight, clearly that's the case, right? If it's here and you look back, yeah, clearly smart money was buying here. So what I'm saying is in the future, if it gets back to this level, that is a smart money level. So as I bring that all the way forward, Natural gas, of course, has had a difficult time, but we finally got back to that smart money level. So I entered the trade here on the 31st of July at 1358. Why? Well, multiple reasons. The first reason is that we rejected the top of the order block, the top of the green box. We went in it and then closed back above it. That is a rejection of the high of the order block. If you look at this bar, I took it here, but this would also be a legitimate entry because it rejected the bottom of the order block. We went below it, then we closed back above. So that's a rejection of the order block, at the bottom of the order block. Here, when I bought it with the rejection of the high of the order block. Either one's fine. So that was the primary reason that I took the trade. So I have primary reasons and secondary reasons. So the primary reason, it rejected the top of the order block. The secondary reasons are that we had a V1. Here is bar 1. Here is bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. That's a V1. I also use V2s. I use these. I teach these in my classes. If you'd like to learn more about V1s, V2s, just go to my YouTube channel, and I have a video there where you can watch. So I didn't take this trade because of the V1. I took it as a secondary indicator. The primary was the rejection of the high of the order block. The secondary was also the V1. In addition to that, this gray line here, this is the negative third ATR channel, or negative third Keltner channel. 92% of prices on average, when they get to this negative third Keltner channel, tend to stop going down or go up. So that's an interesting level to look at. And you can see on the day that I bought it, we were below the negative third ATR channel, yet we closed back above. So that is also a secondary signal. I wouldn't take the trade just because of the V1. I wouldn't take the trade just because of the rejection of the negative third ATR channel. The main reason I took the trade was the rejection of the order block. That's a primary signal. But the rejection of the negative third ATR channel and the V1 give extra bonus points, value points to the trade. Doesn't mean it's going to be a positive trade, right? But they help. So as soon as I saw this, I said, okay, I like the trade. Rejection of the high of the order block, a V1, a rejection in the negative third ATR channel. First thing I need to do is I need to figure out how many shares to buy. And really in trading, how many shares you buy of something is the most important decision you're going to make, to be honest with you. So I have two inputs. I have a simple formula that I use. The first is, how much money do I have in my trading account, right? I take 1% of that and I get that number. Let's say I have $200,000 in my trading account. 1% of that is $2,000. If I have $100,000, 1% is $1,000. If I have $50,000, 1% is $500. If I have $1 million, 1% is $10,000, right? So for this example, let's just say I have $200,000. $200,000 times 0.01 is $2,000. Okay. Now, so I have that. Now I look at what the value of the 2 ATR is. Right now it is $1.07. An ATR means average true range. A 1 ATR is how much we expected to move in any one day. That's just noise. So I take that number, times it by 2 to get my emergency stop level. And the nice thing about 2 ATR, it is factoring in on a daily basis the volatility of the market. If the market's much more volatile, this number is going to be higher. If market is less volatile, this number is going to be smaller. And you'll see why that's important in a sec. So I take 1% of my total capital, 1% of 200,000 is $2,000, divide it by the value of the 2 ATR. So divided by 1.07. That tells me to buy $1,800 1869 shares. For me and my account value and the volatility of the market, for me, this is the correct amount of shares to buy. So as soon as I enter, you can see I entered at 1353. The first thing I do after I buy my 1869 shares, I take my entry price minus whatever the value of the 2 ATR was, minus, and I draw a line at that level. That level is now my emergency stop. So if I have 1,869 shares and it goes down $1.07, how much have I lost? I've lost $2,000 because we just did the math, right? So in the worst case scenario on this trade, if I am really the worst possible wrong, it's going to go down $1.07, and that's where my emergency stop is, and I'll have to get out of the trade, and I will lose 1% of my account, right? It's not fun to lose 1% of your account, but you can recover from that. But the good news is that hitting your emergency stop, or in other words, the price going down 2 ATRs from your entry, that only happens about 5% of the time. The other 95% of the time, if you have a loss, or if I have a loss, it will be because of my end of bar stop. I always have two stops. The emergency stop, we just talked about that. But my end of bar stop is always going to be closer than my emergency stop. Well, my end of bar stop is a close below the low of this green box, a close below the low of the order block, which is like 1291. So on a closing basis, when I take this trade, it almost happened here. 2 days after I took the trade, you see how it went below the low of the order block, yet it closed back in? Had it closed below, I'm out of the trade. That's my end of bar stop. But you can see my end of bar stop is closer than my emergency stop. So I would not have lost 1%. Maybe I would have lost 0.5% or 0.6%. So always two things: emergency stop, end of bar stop. Only 5% of the time will you hit your emergency stop, in my experience. And the other 95% of the time, if you have a loss, it will be because it closed below your end of bar stop. Okay, so now the next thing that I do, so I have the entry, I position size, I place my emergency stop 2 ATRs below, my end of bar stops close below the low of the order block. The next thing I do is I take my entry price and I look for the value of the 1.5 ATR. Right now the value of the 1.5 ATR is 0.8. Whatever it is on the day that I take the trade, I take my entry price plus the value of the 0.45. So it's plus, so it's above the entry price. And you can see as soon as I bought here, I put my trailing stop level at 1439. That is my trailing stop level, 1.5 ATRs above my entry. If the price gets to that level in the future after I take the trade, now I go into what is called trailing stop mode. And trailing stop mode means that now that I'm in trailing stop mode, if I have a close below a previous bar's low, I will take off half of my position at the profit, generally. And why do I do that? Well, as your trade moves up, you want to tighten things up. You don't want to give it all the way back, right? So if I go into trailing stop mode and then eventually have a close below previous bar's low and I sell half, it moves everything up. It tightens everything up by half. Okay? So rejection of the high of the order block as the primary, a V1 as the secondary, a rejection of the negative third ATR channel as a secondary. I position size as I show you, place my emergency stop 2 ATRs below, my end of bar stops close below the low of the values or the order block. Place my 1.5 ATR level above to go into trailing stop mode. So everything I've talked about here so far is defensive, meaning that if something goes against me, I do this. If it goes against me, I get out, or I get out of half, or right? So everything is defensive in nature. But I also want to play offense in my trading as well. And the way that I play offense is I take a partial profit each day if it goes a certain amount from the previous bar's close. So I'm in this trade right now. I'll show you exactly how I do it. I take the closing price of the day. The closing price of the day is $13.20. So I take $13.20. I now look for the value of the 0.45 ATR. And the 0.45 ATR value today, it changes every day, but right now is 24 cents. So I take 13.20 plus 24 cents for Monday. My first profit target is 13.44. And if it gets there, I will take off 10% of however many shares I have. If I go into the day with 1,500 shares, I'll take off 150 shares at that first profit target. But I place 3 profit targets each day. So the first profit target is the closing price plus the value of the 2 ATR, 13.20 plus 24, 13.44. That's my first profit target. And I put a limit order in to sell 10% of however many shares I am going in, of however many shares I have going into that day. But I also do it again. I take my first profit target plus, again, the value of the 0.45 ATR plus 0.24. My second profit target for Monday is 13.68. And I again place a limit order for the day of 10% of however many shares I'm going into the day with. So now if I go into the share with 1,500 shares, first profit target I have 150 as a limit, second profit target I have 150 as a limit, and then I do it one more time. I take the second ATR, 13.68 plus 0.24. The third profit target for the day is 13.92. And I do this every day, and I change it every day because, of course, the closing price is going to be different every day. And the 0.45 ATR value is going to be different every day. All right, so we set up the trade. We know what the trade is. Rejection of the high of the order block, secondary V1, secondary rejection of the negative third ATR channel, place the emergency stop, 2 ATRs below, end of our stops, close below the low of the order block, 1.5 ATR above, and now I know exactly what I'm going to do, right? No matter what. The next day goes up a little, not enough for a profit target, so I didn't hit a profit target. I do nothing. Next day down, but at the end of the day it recovered and closed back above the low of the order block, so it keeps me in the trade. The next day up a little, actually up a little, enough for me to hit a profit target. Now, was that profit target lower than my entry price? Yes, it was. More times than not, they'll be actually profitable. But the market doesn't care whether or not I'm profitable. The market moved a certain amount. I'm going to take advantage of that, even if I'm locking in a little bit of a loss. Next day, up again. Nice. So I hit another profit target. Next day, up again. Hit another profit target right here at the top. Not at trailing stop level. And then Friday, we were down 33 cents back into the order block. So I have no control over UNG. I did my research. I have my setups. It's going to play out how it's going to play out Monday. If it closes below the low of the order block, what am I going to do? I'm simply going to get out, right? If it moves up on Monday enough for me to hit profit targets, I'll hit profit targets and I'll take them off. If we start to rally and we get to the trailing stop mode, the orange line, then I go into trailing stop mode. But that hasn't happened yet. But the key is I know exactly what I'm going to do with this trade. I position size correctly. I was patient, waited for the signals. Doesn't mean it's going to have to work. But the best traders are the ones that follow the rules. Even if you have a loss, if you followed your rules, it was a good trade. If you make a trade on something, you make a lot of money on it, it was a BS trade, that's a bad trade, even though you made money. So really the best thing you can strive for in trading is getting yourself a good trading process, learning a good trading process, and then following it. Like, focus like a laser beam, be precise, follow it. If you do that and you have an edge in your system, then the money will come. That's the key. So UNG currently, this one is down, currently a loss of 2.88%. All right, let's go on to the next trade, Intel. Okay, here we go. So I'll be a lot quicker on this one than UNG. I just wanted to give you all the basics on UNG as far as the charts go. So, all right, Intel. I entered Intel on the on the 4th of August. Why? There was two confluences. The first confluence is the day before we closed below the order block. It was close, but it closed below the order block, and we closed below the 30 RSI. The next day, we closed back above the 30 RSI, and we closed back above the order block. Two primary signals. The first signal, rejection of the order block, so that's an primary order block trade. And then the second signal, it closed back over 30. That is a deep dip buy strategy. Both primary signals. So, you'll see me in my trading. I use these two together, and I love when a deep dip buy and order block come together. Really, it's my favorite trade. And this is what I teach to all my students. We go through very detailed on how we learn each strategy and then how we put them together. But this is a perfect example of how we're combining these. So it's very rare that you will see me take a trade that only has one signal. Just as a general rule, I need to have one primary signal and I need to have one secondary signal minimum to get into the trade. But in this case, it was better. Two primaries. So I entered here 1943, position size as I'm supposed to. I placed my emergency stop 2 ATRs below. I placed my trailing stop level 1.5 ATRs above. And as the trade starts, if I have partial profits, I'll take them, as I showed you, 0.45 ATRs. So the next day, after I bought, and the end of bar stop is they close below the order block. So next day took off like a rocket ship, which was great. I hit multiple profit targets, took those off at a gain, and I also got to trailing stop level. You can see we touched the 1.5 ATR, so now I'm in trailing stop mode. It doesn't mean I do anything, it just means now in the future, if I have a close below a previous bar's low, I will get out of half. Next day we were up a little bit. Thursday we were down, and we closed below the previous bar's low after reaching trailing stop level. What did I have to do when I follow my rules? I had to sell half of the remaining shares. Remember, it's half of the remaining shares, not how much I started with, because I started with full position here, but then I took some off here on the intraday profits, right? So now let's say I have 2,000 shares, and maybe now instead of 2,000, I have 1,500 or something, right? So if I have 1,500, I need to sell half. I sell 750. So I locked in a gain of 1.82% on half of the position. And then on Friday, up a little bit. So the remaining position on INTC on Intel up 2.71%. Okay, VIX. Oh, this has been somewhat of a trade, I'll tell you. Good and bad. Frustrating trade on VIX. But I took VIX here on the 29th of August. No, July, excuse me. Why? Well, a lot of signals. The green box here, this is an order block from the past. Okay? So I entered here at $42 even. Why? Rejection of the bottom of the order block. We also had a V1 from this bar to this bar. We went under the bar 2, went under bar 1's low, closed above bar 1's close, and we also closed back above the negative third ATR channel. So we had one primary and 2 secondaries. So I got long here, $42. I position sized, placed my emergency stop 2 ATRs below. I placed my trailing stop 1.5 ATRs above. Next day, we start off, we're up. Took some profits, and you'll see how important it is that I took the profits when I had them. The next day, really nothing, ended just about the same. And then we had this explosion here where I think I hit 5 profit targets on this day up. 5 or 6. So we had a massive move up. We obviously got to trailing stop level. So now I'm in trailing stop mode. The next day, we have our first close below a previous bar's low after reaching trailing stop level. What do my rules tell me to do? I have to get out of half of the position. I got out of half of the position and locked in a 2 point, let me see. Yeah. Locked in a 2.44% gain, which is great. It's fine. I'm glad that I did that, right? And then we just went down and down and down and down and down. And what did I have to do on Friday? Well, it closed below the low of the order block. That was my stop. So on the remaining shares on this particular trade, I took a loss of 2.66%. But this is a good example, everyone, of why it's, at least in my opinion, why it is so important to take partial profits. Let's review it again. Okay, I have the entry, rejection of the rejection of the bottom of the order block, plus the V1, plus the rejection of the negative third ATR channel. Took a profit target here, no profit target here. Do you think I'm glad that I took a lot of profit into this huge move up? I took something when the market gave it to me? Of course. Of course. I mean, I took a minimum of 50% of the trade off here, way up here, right? And then going into trailing stop mode with the close under the previous bar's low after reaching trailing stop level, I took half of what I had remaining after I sold all this on the way up. So for me, taking partial profits is extremely important. Take something while the getting is good, because the getting can turn right back around. Can you imagine if I would have entered this, just held it, and had this huge gain of 11 or 12%, and now had this loss of 2.66? Not fun. So that didn't happen, right? The importance of taking profits when you have them, the importance of going into trailing stop mode to tighten everything up. So yeah, it's unfortunate that we closed below, but that's life, that's fine. 2.66% loss, was it really that much? No, not at all, because of all the profit taking and so forth. But regardless, the remaining shares, I did stop out for a loss of 2.66%. All right, Netflix. Really what I was looking for on Netflix was for Netflix to come down into this lower order block. It never quite got there. So there was an existing order block up here that I keyed my trade off. So if you're below an order block and you close back in it, that's a legitimate signal. So I got back into Netflix here on the 7th of August. Why? The previous day closed back into the order block. I didn't take it here, but I decided to take it here because on Thursday, during the day, we went below the order block again and closed back in it. So that's 2 days. The first day was, okay, this just could have been a bounce and closed back in the order block. But the next day, intraday, we went below it again, and the market said, no, there's really no more sellers down there, so we're going to close in here. So, why is my... Can I move that? I'm not sure. So, I got long here about 1181. It's expensive stock. So as soon as I get long, what do? I position size. I put my emergency stop how far below? 2 ATRs. Where's my end of bar stop on this particular trade? Well, I took the trade because it rejected the bottom of the order block. So therefore, if it closed even 1 penny below the order block like VIX did, what am I going to do? I'm going to get out. Will I lose 1% of my count if it closes just barely under? Of course not, because even down here with my emergency stop, I would only lose 1%. So I'd lose a very fraction of that. So a level was rejected. I position size based upon the volatility and my account value. I have a good risk to reward. That's all I can ask for. If the next day it just closed below, I just get out. But fortunately, it did not. It went my way. Orange line up here is what? 1.5 ATRs above. I go into trailing stop mode. Did I get into trailing stop mode on Friday? Yes, already. And did I hit multiple profit targets? I did. I hit 2 profit targets from where I bought it because I bought it at 1181. So this is a nice position to be in. I've taken some profits off at a profitable level. I've reduced my position size. I am now in trailing stop mode, which means in the future, if I have a close below previous bar's low, I will take half off. And again, it's moved my way. It's moved enough my way to start to tighten things up. And by going into trailing stop mode and selling half, it just by default, that tightens everything up because now you only have half the position, right? So this particular trade, doing well, up 2.55% so far on the trade in one day with the order block. All right, so those are the 4 open daily positions, and then let's go to McDonald's, which was a closed position. So McDonald's, really good trade. I really got in at the low. I got in all the way back here, June 26 of 25. What were the confluences? Well, this was not an order block trade. This was a deep dip buy trade. In a deep dip buy trade, we key off of either the black line, which is the 200-day moving average, the purple line, which is the 250-day moving average, or the orange line, which is the 300-day moving average. So on this particular day, the day that I bought McDonald's, we went below the 300 during the day, closed back above it. That is called an intraday rejection 300. That is a legitimate primary signal. In addition to that, I'm looking for those secondary signals. What was the secondary signal? The secondary signal was a V1. The day before, look at the low. The day of, we went below day one's low and then closed above day one's close. That is called a V1. So primary was the intraday rejection of the 300-day moving average. The secondary was a V1. I got long at 285.61. I position size correctly. I placed my emergency stop 2 ATRs below as always. My end of bar stop is simply closed below the 300-day moving average. Look how close I am to that. If the next day it just closed 1 penny below, I'm just out. I placed my trailing stop level 1.5 ATRs above. Next day takes off like a rocket ship. Take multiple profit targets off into that strength. Next day up a little, and I get to trailing stop level. So now I'm in trailing stop mode. I don't do anything, but I'm in trailing stop mode. The next day up again, multiple profit targets again on this strength. Really great. And I'm in trailing stop level, but we haven't closed below previous bar's low. Then we go sideways for 3 days. We don't do much. And then here on the 8th, we have our first close below a previous bar's low. After reaching trailing stop level, what do? I take off half of the remaining shares that I have. I took off half for a gain of 2.12%. But I kept the other half in case it keeps moving up, and it did. Next day we go up, not enough for a profit target. Next day we go up, hit multiple profit targets. Next day we go up, hit a profit target here. And then we just kind of moved sideways for a while. There was a profit target here. 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 And then here I exited on the 5th of August at 298.80. Why? Simply for the fact that the next day was earnings, and I do not hold my positions through earnings. It's a very fast way to make money if you're right. It's a very fast way to lose a lot of money if you're wrong when you're playing earnings. And so, as a manager of money, as a trader, my number one mission, I guess, is the stewardship of the money. I have to protect the money more than anything else. And holding a trade through earnings is a really good way to lose money quickly. So I choose not to do that. So I got out simply for the fact that we had earnings. The remaining shares that I had getting out here looks like for a gain of 4.38%. So not bad. So half at 2.12%, the other half at 4.38%. And it is a little bit higher since the earnings. Okay, so those are all the daily trades. Let's look at the weekly trades now. Weekly trades, I make my decisions on weekly trades on Fridays, because the weekly bars close on Fridays. So this is UUP. Again, every bar is a week. Really good setup on UUP. It's profitable, but lots of confluences, which I like. So you can see this green box here. That's an order block from the past, right? So now that we've come back to the order block, I'm looking for some kind of rejection. Well, the day that I took it here at 27.21 on 7-Eleven for multiple reasons. The first, look at the black line, deep dip by 200-week moving average. The previous bar, we closed below. Next bar, where I took the trade, we closed above. From a deep dip buy, that is a legitimate signal. Close under, close over the 200, that is a legitimate primary signal. In addition to that, we also rejected the high of the order block, because the previous bar we were in the order block, but then we closed back above. That is a rejection of the high of the order block. So I have two primary signals. Close under, close over the 200-week moving average, and then rejection of the high of the order block. Two primary signals. That's really good. Was there any secondary signals? Yes, there was. There was a V2. V2 consists of 3 bars. Bar 1, bar 2, bar 3. Bar 2 goes under bar 1's low. Bar 3 closes above bar 1's close. Secondary signal, not a primary, but it helps. So with all of that, I took the trade. I took the trade 27.21. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop on this trade is simply a close below the 200-week moving average, the black line. That's it. Next week, we're up. Hit a profit target. Next week, we're down. Did not hit a profit target, but we did not close below the 200-day moving average. The next week, big ups, and I hit multiple profit targets into that strength. And we also got to trailing stop mode. So now I'm in trailing stop mode. Doesn't mean I take any action. It just means I'm in trailing stop mode. This week was down, but we did not close below the previous bar's low. Had we closed below last week, or the week before's low, I would have gotten out of half, right? If you get to trailing stop level, and then in the future, if you close below previous bar's low, you get out of half. Well, it did not close there. It did not close below the previous bar's low, so I'm still in the trade. So, so far with this particular trade, up 0.84% on UUP, which is the US dollar. All right, TLT, I've been in this trade 127 years, it seems like. But it's not bad. It's profitable, and I have gotten dividends for 4 months. So we go all the way back again. These are weekly bars. We go all the way back to the 17th of January. I took the trade at 87.20. Why? rejection of the high of the green order block. Secondary signals, V1 and a close under, close over the negative third ATR channel. Got long at 87.20, position size correctly, placed my emergency stop 2 ATRs below. My end to bar stop on this trade, closed below the low of the order block. Placed my trailing stop level 1.5 ATRs above, and right out of the gate did pretty well. The very next week was about even. The next week was up a little. Next week up nicely, where I took some profit target into that strong move up, so took some off. Next week, really nothing, pretty much unchanged, no action. Next week, really nothing. Next week up nicely, where I hit multiple profit targets. We had a month worth of sideways motion, and then we had this big move up here, January, February, March, April 4th, where I hit multiple profit targets. And again, I took off profits into this strength, and I'm in trailing stop level. Then we had the huge meltdown here in bonds on this week, where, remember, I'm in trailing stop mode, where we closed below a previous bar's low after reaching trailing stop level. My rules told me I had to get out. I had to get out of a loss of, I think, what did that say? 0.69%, right? So I took off half. Next week, we're up, profit target. Next week, we're up, profit target. Then we go down for a month straight, no profit targets. But again, I'm staying above the low of this order block. I'm not closing below, so I stay in the trade. Next week up, profit targets, sideways, kind of dripping ourselves up, then we drip ourselves down. Then for the change from this week to this week, profit target, change from this week to this week, profit target, and then this week was down a little. So I'm basically, on the remaining shares, I'm basically up a little, like 0.05% of that. But, let's look at this in context. I have had this trade for 7 months. I've made 7 months worth of dividends. I did take off portions at profitable levels on this trade. You can see, taking something when the market goes your way is not a bad idea, right? So all in all, this trade is positive, both from a share price perspective, but in this particular case, really because of the dividends as well. So, on bonds, you're not going to make huge amounts of percent, but all in all, I'm pretty happy with this trade from a dividend perspective. Okay, last open position, XLV on the weekly. I took this yesterday on Friday. If you have been watching my channel over the last few months, when I'm looking at the potential trades for the previous week, you've heard me talk about XLV many times. We have this beautiful order block down here, and we have this 300-week moving average deep dip buy running through it. And this is a good example of seeing where you want to buy it, not doing anything until it gets there. I have been watching this particular setup for 3 months. And I finally took action on Friday because it did what I was not expecting it to do. Basically, it did what, well, how should I say it? I thought if it does this, if it gets there and does that, then I'll take the trade. Well, that's what it did. So I took the trade. All right. So again, why did I take the trade? 2 primary signals. The first signal is that we bounced at the 300-week moving average. That's a deep dip buy. That's a legitimate entry just by itself. Secondly, we came down, rejected the high of the bullish order block. That's 2 primary signals. So I took the trade, $130.07. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop for next week, for next Friday, is simply a close below this orange line. Simply a close below the 300-week moving average. If it closes below, I'm out. But you see how close I am already? So I have major levels of support levels that were rejected in my favor. That's why I took the trade. Position size. Worst case scenario, I'm going to lose 1%. That only happens about 5% of the time. The other 95%, if I lose on this trade, it will be because it closes below the 300-week moving average, and that's it. Place my my trailing stop level up here, 1.5. If it gets there, I go into trailing stop mode. If it moves up next week, 0.45 is 244. So how do I place my profit targets for next week? Easy. Closing price, 130.16. Plus 244 is my first profit target. Take my first profit target, add the 244 again. That's my second. Take my second, add 244 again. That's my third. Hey, if I'm lucky, maybe I hit 1. Maybe I hit 2. Maybe I hit 3. Maybe if it goes down, I don't hit any. Right? So this trade's just about break even. I'm up a little bit, actually. I got in 130.07. That's 130.16. So that is XLV. Okay. So last but not least, Shopify. And this was a short position, and my rule of getting out before earnings really, really saved me on this particular trade. So I got short here, Shopify 127.03. I've been talking about bullish order blocks, but there are things that are called bearish order blocks, and a bearish order block happens here. We have a swing high, we have a swing low, we have a higher swing high, and then we break structure to the downside. So if we rally back to the order block, that is where I like to short. So I shorted here 127.03 with the rejection of the high of the order block. Place my emergency stop 2 ATRs above. I place my end of bar stop with simply it close above the high of the order block. I place my 1.5 ATR trailing stop level below. The next week, it went down, right? I wanted to go down, I'm short. It went down, I hit a profit target. I took profit target. The next week, went down again, I hit another profit target, right? So I've locked those in. Then I got out. I got out exactly, ironically, where I shorted the trade at 127.03. Why did I get out here? Because the next day was earnings. I didn't want to hold through earnings and have that risk. So I covered and got out. Thank goodness. You imagine? Oh no, I'll gamble on these earnings. I would have got cremated, right? So that's why I highly recommend not holding through earnings. So all in all, this trade, I got out the remaining shares at even, but all in all, I made money on the trade because of the partial profits I took before I got out. All right, so hopefully that gives you an idea of, like I said, it wasn't the best week in the world. There's not a lot of setups at this moment with this crazy market for the way that I trade. But, I tried to do the best with what I had. And some weeks I have a lot of setups. Some weeks I don't have a lot of setups. But I do have some potentials for next week, and we'll get to that. But first, let's talk a little bit about trader psychology. And, oh, by the way, if you have any comments or questions about the trades that I just went through, please put them in the comment section. I'll do my very best to get back to you and to answer your questions. But yeah, let's go on and talk a little bit about trader psychology, and then we'll get on to the potential trades for next week. Okay, this comes from my good friend Steve Burns. The majority of the trader psychology sections, when I look for posts, come from Steve. He is a great trader. He is a great author. I think he's written almost 44 trading books. Do yourself a favor, go to Amazon, read one of his books. My favorite is probably Moving Averages 101. When you hear me talk about deep dip buys, I'm using a lot from what I learned from Steve with Deep Dip Buys 101. And I actually wrote the foreword to that book as well. So anyway, any book from Steve Burns, great. Check him out on Amazon. And you can also follow Steve at @SJosephBurns on Twitter or X, whatever they call it these days. So this is from Yvan Baiji. That's the best. Sorry, Yvonne, if I mispronounced that, but That one kind of surprised me there. But but Steve shared this from this gentleman, and this gentleman wrote a really good post, and let's see what it says. One good trade at a time, and 6 months from now, you could be in a totally different place financially. One good trade at a time. Folks, there's so much wisdom in this small sentence. You know, I have a rule, and we're going to get to that in a minute when we look at the potential setups for next week, but I only take one trade per day. Why do I only take one trade per day, even if I have 10 potentials? Because I want to just take one good trade at a time. I take maybe one good trade at a time on a daily. I take one good trade at a time on a weekly. I want to take the best trade of the day. Doesn't mean it's going to be profitable, but it means the way that I trade, the way that I look at things, risk to reward, confluence of signals, that's the best trade of the day. That's the best potential for me to make money. And, you know, I talk with a lot of traders around the world, and some of them are just crazy. They just take many trades, they pile on, and sometimes they do great with it, but sometimes they do horrible with it. But this gentleman here, Yvonne, one good trade at a time, and 6 months from now, you could be in a totally different place financially. You know, when I look at the internet, I look at YouTube, I look at people trading, they tell you, in my opinion, a lot of them just tell you enough to just get you into trouble. You know, when I look at trades, I try to tell you exactly what I'm doing, exactly. If it does this, I'm going to do that. If it does that, I'm going to do this. Right? If somebody says, "Oh, hey, you should buy Tesla," okay. Well, what about if it goes down? No, it's okay. What about if it goes up? No, just keep it. I mean, you know, get yourself a plan. You have to have a plan on whatever it does to the downside or to the upside. But if you concentrate and take one good trade at a time, what's a good trade? Multiple confluences, good risk to reward ratio, proper position sizing, and a plan. That's the key. And if you do that and you're patient, just like the XLV trade I just showed you, I've been waiting for that trade for 3 months. I didn't know if it was ever going to get there, but it did. Got there, so I took it. So, you know, I kind of challenge you, tighten up your trading, tighten it up. Be patient, wait for those confluences, take the trade, and then follow your plan. And if you do that consistently, it doesn't mean you're going to make money on every single trade. You're going to have days, you're going to have weeks, you even have a month where maybe you're in a drawdown, but that's all part of it. If you do the right thing for a long enough time, that's how you make money in trading. So thank you, Steve Burns. Appreciate this. Thank you, Yvonne, with your last name I can't pronounce, but really good, really good post. And so think about doing that. One good trade at a time and follow your rules. Okay. Oh, sorry. Listen, I went down through my watch list last night, and I had a difficult time finding a lot of potential trades for next week. You know, the market is just, one part of the market has just gone straight up. The other part of the market has just gone straight down. And so for this week's podcast, I actually had to go outside of my normal master watch list to find some legitimate trades. So I only have 4 potentials for next week, but that's fine. They're really good, right? All I need is one, right? So, and like I was just saying in trader psychology, here I have 4 signals. Monday, potentially 4 of these could all be legit. Does it mean I would take 4? No. I'm only going to take one. I'm going to narrow it down to the best one. The one that has the best quality score. The one that has the most signals, best risk to reward ratio. which one looks best on higher time frames, what the relative strength was of this, right? That's how I trade, and that's how I teach. I teach private. I teach a private one-on-one course. It's a 20-hour course. I teach you all the strategies. I teach you all the rules. We do a lot of simulation, a lot of practice. I've been teaching for a long time. I have taught people in so many countries: Europe, America, uh, uh, Ukraine, Russia, Singapore, right? Australia, South Africa. I, it's great. I love teaching students. I love teaching people how to trade. I've been trading for over 30 years. And if you take my one-on-one course, the 20 hours, we'll spend 20 hours together and I will teach you everything that I know. You'll learn a really good skill. So if you need help with trading, if you need to learn if you need to learn the proper way to trade, you need to learn a good process, I can do it for you, and I'd be glad to do it for you. I also do consulting. I consult with hedge funds. I do weekly consulting. Not something really I ever set out to do, but I just started to do it with some of my previous students where we spend an hour a week together, review their trades, if they're doing it right, if, looking for new trades for the next week. So I've kind of been expanding to doing more consulting and more one-on-one work in addition to my course. But listen, if you've ever thought about really learning the skill of trading, I can teach it to you. I do a good job of it. And all you have to do is send me a email. My email is in the link in the description, and I'll reply, and we can have a little call together and kind of get to know each other, see if it's a good fit. But I'd love to have you as a student, so please reach out to me, and we'll spend 20 hours together learning trading. And of course, the one-on-one course is really the best way because I teach you everything. But it is more expensive, obviously. But I do have a really good online course available at udemy.com. The link's in the description as well. That's somewhere between $30 and $50, but it's a great course. I've sold so many of those around the world. It's 9.5 hours of video, and I teach you step by step how to trade the deep dip buy approach and strategy. It's really good. So there's that for you as well. Either the one-on-one 20-hour course or the 9.5 hour video course on deep dip buy. But they're good products, if I say so myself. And I don't think I've ever had a student or someone that's become my student and says, yeah, that was a bad idea. They always seem very happy and pleased they've learned a lot. So anyway, that is my plug. But let's get on to the potential trades for next week. So, okay, here we go. Here we have Boeing. Well, you see a red box up here. What does a red box mean? Well, a box is an order block. If it's green, I'm looking to buy. If it's red, I'm looking to short. So this is Boeing. I'm looking to short. Why? Well, we had a change in structure. We had a swing high over here. Then we had a swing low over here. And then we have a higher swing high here. And then this big move down here broke structure. So now we are in a bearish market structure. If I'm in a bearish market structure, I want to short if we get back up to the highest up bar close before market structure change, right? If it's a bullish, if we change from bearish structure to bullish structure, I'm looking to buy the dip. If we change from bullish structure to bearish structure, I'm looking to sell the rip or sell the rally. So the level that I'm looking at, we're not there yet, but there's the low of the order block. So the high of the order block is 236.63. The low is 232.91. So that defines the order block. But what caught my eye here is this big down bar on the 29th of July. See the big, huge down bar on the huge volume? A lot of distribution going on there. So if you have a down bar, if you take a big down bar and you take the high and you take the low, go to the halfway point. The halfway point will be resistance if the bar's down. If it's big up bar, then getting back to halfway is support. But on a down bar, going down big and then rallying back to halfway of that, that is resistance. Well, that halfway inherent resistance of that bar just happens to dovetail with the bottom of this order block. So those are two areas of resistance that I personally will be looking to short. But we are going to have to reject that before. I'll give you an example here. I can change this here on Trade Navigator. So this was Friday's bar. However, if Friday's bar had done this, I probably would have taken the trade already, right? Because it rejected, on a closing basis, it rejected halfway at the big down bar and rejected the low of the order block. If I took this trade, how would I set it up? Well, I position size, I placed my emergency stop 2 ATRs below. Where would be my end of bar stop? For me, it would simply be a close back above this halfway bar, giving myself a good risk to reward ratio. So if I shorted it here, and then the next day it ends up here, I'm out, right? So that's my line in the sand. So we didn't do this on Friday. This is me just showing you what it would look like. So here we are going into Monday. If it did what I just showed you, if it got to the halfway and then closed back underneath it, that's a rejection of the midway point of the big down bar, and it's a rejection of the bottom of the order block with the good risk reward ratio. That's what I'm looking for on Boeing. Whether it gets there or not, I have no idea. Don't have any control over that, but if it does, I'll consider taking the trade to the short side. Walt Disney. Boy, it's amazing how a lot of just companies that have to do with tourism, are just going down. I was just watching about Las Vegas, about the slowdown in the Las Vegas. You know, there's a slowdown with consumers in America. That's why all the money is piling into tech momentum. And that's kind of why normal companies like cruise lines, cruise lines, car companies, really having a tough time. Well, same with Disney. Obviously, Disney is an entertainment travel, leisure kind of company. And look at this. Everybody wanted it. Everybody wanted it. Everybody wanted it. Oh, wait, no, never mind. Never mind. Never mind. Nobody wants it. Nobody wants it. Nobody wants it. Nobody wants it. Well, if we go back to this order block here on 523, again, why is it an order block? Well, we had a swing low. We had a swing high. We had a lower swing low. We changed market structure to the upside. If you go here to the basically June 30th, and look back in time, can you make the assumption when you're up here that the people that bought down here were smart money? Yeah, 100%. It went from here to here. So if we get back to that level now, is it smart money again? Maybe. Maybe it is. Maybe it's not. Maybe we've had some seismic shifts and this area is not smart money like it was back here in hindsight. But maybe it still is. And so this is what I am looking for. We are coming back down close to that order block. Is it going to get there? I have no idea. Depending on how long it takes Disney to get down here will change the RSI level. I tend to only buy something with a confluence. So if we come down, reject the high of the order block, is that enough for me? Depends. It depends how it does it. Maybe we come down, we close in the order block, and then the next day we open lower but end up higher, and then we have a primary and we have a secondary. Primary would be a rejection of the order block, but the secondary, maybe it's a V1. Maybe, depending on how long it takes to get down here, maybe we go under 30, over 30, deep dip buy inside the order block. That would be legitimate as well. Of course, we have the 200-day moving average all the way down here as well. Not in the order block, but close. So really, I'm just, the first thing is, if it rejects the order block, how did it do it? Did it just reject it, or did it reject it with the V1 or V2? Did it reject it with an under 30, over 30? It's really going to depend on the price action of getting down there. And maybe it just goes up from here and I don't even get the trade. But I am looking at Disney. I'm looking kind of at this level between 109 and 108 and looking for some kind of price action inside of it, like a V1, V2, under 30, over 30. Maybe even abandon baby. Maybe we gap down and then gap up. If you want to learn more about abandoned babies, go to my YouTube channel. You'll see a video there. But if I get a bullish abandoned baby inside the order block, I definitely consider taking that too. So, a lot of different things could happen with Disney here. I'll just have to watch it. But in this general area, I guess call it, 108 to 110. This is an interesting area that I'm looking for. Energy Transfer. All right, you don't hear me talk a lot about this company. I'm very familiar with this company. It's an energy company, obviously. But like I said, I had to go. God, excuse me. Many apologies. I had to go outside of my normal watch list to find something. But this is a good setup. Really good setup. We have an order block here. Again, why is it an order block? Well, because back here we have a swing low, then we have a swing high, then we have a lower swing low, then we change market structure to the upside. Lowest bar close before market structure change defines your order block, the high and the low, the lowest bar close. Here we go. Okay, so Thursday we rejected the high of this order block. Is that legitimate entry for me? No, it's not, because the risk to rewards not that great. But what I do like about ET is you see the 250-day moving average that lives inside of this order block. That would be great. Friday, for example, if we had done this, I would consider taking that trade, because we intraday rejected the 250-day moving average inside of the order block. Yeah, that would be great. It's one of my favorite trades. Deep dip buy, order block combo. But we're not there yet. So next week, depending on how this plays itself out, if we reject the either a close under, close over, bounce, intraday rejection of the 250, I would certainly consider getting long there. By the way, Energy Transfer pays about 7%. It's pretty good. So that's what I'm looking for on ET, is some kind of rejection of the 250-day moving average inside of the bullish order block. WES, Western Midstream, very similar business model as ET. Nice potential setup for next week. We have the order block here. The high is 37.54. The low is 36.72. What do we have inside of the order block? Major moving averages. We have three of them. We have the 200 here. We have the 250 here. We have the 300 here. So you can see we've had a big sell-off the last couple days. So I'll have to see next week if we reject the 200-day moving average. Maybe that's where it's going to hold and go back up. Maybe it goes lower, rejects the 250. Maybe I get long there. Maybe it goes all the way to the bottom of the order block, rejects the order block, and rejects the 300. Ideally, that would be the best spot, 100%, because you're lower price, right? I always like the lower price, and the confluence there of the bottom and the 300. But it may just get to the 200 bounce. It may go down. Maybe it will respect the 250. Just don't know. So I'll just have to see. But those are the levels that I'm looking for. I'm looking for rejection of the 200 at 37.41. I'm looking for rejection of the 250 at 36.97, or rejection of the 300 at 36.73. Western Midstream, WES, by the way, this pays, I think it pays 9.5% dividend. So I like this. Best thing, one of the best things that could happen is I enter the trade with a good risk to reward ratio, stay in that trade for several months, and get a nice dividend on top of the capital appreciation. Right? Different way to look at things. Okay, so those are the dailies. Let's go to the weeklies. I've got a few more on the weeklies. All right, I have been tracking Adobe for weeks and weeks and weeks, just like on XLV. We have, again, weekly now, we have this order block, swing low, swing high, lower swing low, market structure change. It defines the high and the low, the lowest bar closed is the order block. Bounced here, didn't take that trade. Almost took the trade on a Friday. because it almost rejected the bottom of the order block. The bottom of the order block is 341.31. We closed at 341.05, which means we closed under the order block. So no trade. So next week, if we close back in the order block, I would consider taking the trade. But Greg, where's the confluence? Well, depending what happens next week, there could be a confluence, V1 or a V2 or something like that. But what I'm looking at right now that I can see, we have a double bottom bullish MACD divergence at the moment. Look at this low here. Look at the deep red MACD bars here. Look at the low here. We're just as low as over here. The MACD bars, the momentum bars, are very shallow. This is not as deep as over here, right? What does that mean? That means from a momentum MACD perspective, this move down did not have the momentum from a MACD perspective as this one. In other words, it means you're running, from a MACD perspective, it means you're running out of sellers. And if you run out of sellers, what happens? Usually the price goes up. So from a MACD perspective, this is telling me that we are running out of sellers. So I want to dovetail that along with an entry, and the entry would be a close back above the bullish order block, right? This is how I look at things. Again, this is what I teach my students. All these MACD things as well. You have to learn the different components, and you have to blend them together, right? And that's what I teach all my students, is how to do this and how to look at this. So close back over the low of the order block, I would consider getting long Adobe. Amazon, you see a red box up here, that's a bearish order block. Swing high, swing low, higher swing line, market structure change. If we get back into the bearish order block, I will consider shorting. Well, you can see it got back into the order block and then came down. I did not take the trade, but what I'm looking at, for me, I guess I should have, in hindsight, taken this trade back on 725 when it rejected what I wanted it to reject, but I didn't take that trade. But I can take another shot at it going forward. If we go up, I'm not going to short just a rejection of the bottom of the order block at 225.86. I want the rejection of 233.70. What's so important about that? Because we have a big down bar. We got back to exactly about halfway, and you can see that was it for Amazon. Came down, but I didn't take the trade. So if it gets back up and does it again, I'll take a shot at rejection of 233.70 if I have a good risk to reward ratio. Google. All right, Google's very interesting. We are back in a bearish order block. Swing high, swing low, higher swing high, market structure change. We are right back there. But Google's very strong. So where am I looking to short this? Very simple at this point. Look over here on 131.25. The high is 205. So next week, if we go above 205 and then close below 205, I will consider taking a short because it's a good risk to reward ratio. As long as it doesn't close above 205 again, might have a chance of a move down. If not, and it closes at 205.01, what do? I just get out of the trade. But the signal is here. We are in a bearish order block. That cannot be disputed. If we close above that order block, okay, then it kind of changes everything. But so far we have not. So if I get a rejection of 205 next week, I consider taking a short position. Almost exactly the same with Walmart. Here you have a bearish order block back on 2/14, Valentine's Day. The high is 104.76. The low is 173 cents. We did not, it looks like we did it this week, but we did not. We did not reject the high. The high is 104.76. Next week, if we reject 104.76 and close under, I will consider taking the short because I'm so close to my end of bar stop anyway. So technically I'm in a bearish order block where more chances than not it's going to go down. If it doesn't and I'm wrong, I can be wrong very small. That's what trading is. XLE. All right. So seems about the only thing on sale at the moment is energy related. And we have a green box here, green order block, bullish order block. We have the 200-week moving average inside of the bullish order block. That's my favorite setup, right? So next week, if we bounce at the 200-week moving average, if we intra-week reject it at the 200-week moving average, then I would consider taking the trade because it's a rejection of the 200-week moving average inside the bullish order block. So that is what I'm looking for. So I hope you found this helpful, everyone. If you did, I would appreciate if you could hit the thumbs up button. If you are interested in working with me and having me as your teacher for the 20-hour course that I teach, please contact me. I would love to have you as a student. I will teach you everything I know. I'll give it 110%, and I think you're going to be really happy that you did. So just reach out to me. It'd be nice to meet you. And I always like to leave off with, please try to go out and do something nice for somebody every day. If we all did one nice thing, it would make the world a whole lot better place. If we could do one nice thing for an animal each week, that would be great. Or each day, that would be great. If you have the opportunity, what's it going to hurt? They appreciate acts of kindness just like we do. But thank you for your time. Again, I hope you found it helpful. I hope it kind of broadens your mind as far as trading, because I want you to be a successful trader. And again, if you have any comments, questions, please put them in the comment section and I will do my best. But enjoy the rest of your weekend, everybody, and I really appreciate you being here. Thanks so much. And God willing, I will see you next week. Take care, everyone.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.